Hello everyone, welcome to our deep dive on preparing to sell your business. My name is Matt Wilmot. I'm a director in the corporate finance team at Francis Clark. I specialise in M&A and in particular company sales. I'm joined on the panel today with some expert colleagues across due diligence, M&A and taxation. They'll give brief introductions in a moment, but before we do that, I just want to give an overview of the purpose of today's session. So in today's market, we're seeing transactions take substantially longer than they have in the recent past. Buyers are being more cautious and they're taking longer in due diligence. They're being more thorough, which tends to lead to more issues coming out and more opportunities for buyers to chip or renegotiate prices. We're seeing a direct correlation between those businesses that are well prepared and more proactive in their planning and the successful outcomes that they achieve versus those that are being more reactive when an acquirer comes along. Now, from a team perspective, we undertake last year over 70 transactions, both for sellers, but also for buyers. And that experience on looking at both sides of a transaction, in particular, how buyers will look at things, how they will value things, and how they undertake due diligence really informs how we've been informing and advising our clients in how they could be prepared. So what can sellers do and how can they be prepared and when should they start thinking about some of these things ahead of a sale? So during today's session, we'll look to give a brief overview of a wide range of areas. There's a lot of topics to cover. Please feel free to ask any questions that you might have along the way. We'll endeavour to cover those as we go or pick up the end subject to time. So without further ado, let's crack on with the introduction. So Nicola, would you like to go first?
Thanks, Matt. I'm Nicola Clark. I'm a tax partner here at Francis Clark. And I specialise in advising on transactions, including sales, management buyouts and employee ownership trusts.
Thanks, Nicola. Chris?
Yeah, good afternoon, everyone. My name's Chris Bishop. I'm an associate director in the corporate finance team at Francis Clark. I specialise in mergers and acquisitions, so essentially advising on transactions such as trade sales, debt and equity transactions and management buyouts.
Thanks, Chris. And Matt?
Yeah, good afternoon. I'm Matt Pearce. I'm a manager in our financial due diligence team, which means I'm normally working on the buy side of these transactions for a range of private equity and corporate buyers. Yeah.
Thanks, Matt. So you've met our panel. So let's crack on with the first opening questions. Now, let's start from the start. Seems like a good place. So if someone is a shareholder is contemplating a sale, where do they begin? How do they kick off that process? Chris?
Yeah, so I think the first thing we do generally is consider objectives. So objectives and actually whether those objectives differ between the various stakeholders in the business. Sort of acknowledging that, you know, whilst it might seem that the objectives of the various stakeholders are the same, actually quite often they do slightly differ. So what might objectives be? I mean, it might be as simple as actually selling and getting the best financial value possible on an exit, but it might not be. It might be actually we want to exit, but how do we protect the legacy of our business? How do we ensure there's appropriate succession? You know, there might be children in the business, other family members that actually, you know, what does their succession plan look like? It might be a partial exit or a complete exit. So, you know, depending on those objectives, what options are actually available in terms of sort of transaction types to meet those objectives? So if we're looking at an example, so if the key objective is value, then it might be that a sale to a third party, you know, trade purchaser, so someone who we term as a synergistic trade purchaser, essentially someone who's willing to pay the most by achieving some synergies, that could be the preferred route. But actually, if legacy and sort of protection of that is a key objective, then that might not be the way to go. You know, typically, a synergistic trade purchaser might not look after the business in quite the same way as some other types of buyers. Equally, it might be that perhaps it's not to a third party at all. It, is it an MBO, so a sale to a management team, or perhaps an EOT? So there's all sorts of options, and just understanding what the main objectives are I think is the crucial point at which we start the process.
Yeah, I think it's probably fair to say that
and this is something we.
Oh, sorry, no. I was going to say it's fair to say there's probably some conflict between some of those objectives sometimes, and managing those is obviously critical to getting in the right direction. Sorry, Matt, off you.
I was going to say that this is something that we sort of look to find to sort of formalise through what we call an options review. So sitting down with sellers and management and understanding what all of those different objectives might be, and then off the back of those objectives, look at how best to achieve that. What options are available for actually being able to achieve those objectives. And once we've done that, we can look to then go through to the next step, which would be a feasibility review, to understand of your chosen options, how achievable is that, and to make that happen, what steps does a business need to go through, or what funders are out there that could help fund this, and bits like that.
Thanks, Matt. Nicola?
Yeah, as any part of any options or feasibility review, or considering what your objectives are, tax is a key consideration. So it's important to understand what your net proceeds might look like. So, for example, on a trade sale, the proceeds would normally be taxed at capital gains tax rates of 20% or 10% for business asset disposal relief. But different types of consideration are taxed in different ways. So an earn-out might be common on a trade sale, which is where part of the consideration depends on the future performance of the business. That's taxed in a particular way, and usually the value of that earn-out is taxed as part of the upfront proceeds. Then looking at different types of structures, an employee ownership trust, if that's the kind of legacy that you want for your business, there's a full relief from tax on a sale to an employee ownership trust, although you might expect to receive sort of overall slightly lower consideration in the valuation than you might do on a trade sale. Then a management buyout, usually that's partly funded by deferred consideration, so often you will receive some cash, but then also shares and perhaps loan notes, and the gain on that deferred consideration often won't be realised until a later date when they're redeemed or sold in the future, and so the tax position might depend on the rates at that future time. Then also part of any initial review, it's also important to consider sort of any pre-sale tax planning, which we'll look at a bit later in the webinar.
Brilliant, thanks, Luca. So quite a lot to think about in terms of establishing your options. I think for the purposes of this session, we'll proceed on the basis that a shareholder is keen to do a trade sale and they're looking to maximise value. But clearly, a lot of these things will be relevant regardless of the transaction that you're looking to undertake. So I think when we look at a sales process, there are obviously various steps, and understanding those steps in the process can obviously help in the, once you understand those steps, you can be prepared for those steps. So perhaps, Chris, if you could outline, what a typical sales process looks like, and perhaps some of those things that, may be relevant to people when they're just trying to understand what those key steps are.
Yeah, sure. So yeah, multi-stage. And quite a lengthy process. I think there's a sort of important realization up front, really. So as with any process, the key bit at the beginning is a planning stage, and a lot of what we cover today, and some of the things that Nicola has just mentioned are elements that would be addressed in that planning stage. The planning stage in terms of length of time is an interesting point, because actually some businesses actually are ready to go to market almost straight away. But actually, we work in that planning stage with potential clients for years sometimes. But let's say we've moved through that planning stage and sort of have pressed the button on a transaction. What are the next steps? So the first steps really is working to pull together a set of documents that you're actually going to go and approach the market with. So sales documentation. The key document within that is what's known as the IM, the information memorandum. 20, 30-page document setting out various information about the business, key sales document, but there's other documentation as well. Alongside that, we'll be working to basically identify potential buyers, so who you're actually going to approach. That's generally done sort of hand in hand with your client, and I think we're going to touch a little bit more on how we go about that a bit later. So once you've identified your buyers, really your next stage is your go-to-market stage. And how do we do that? I mean, the key word probably there is confidentially. So we go to market confidentially, typically with a 1-page short teaser document, no names. And once we've got some interest off that, and once we've got some signed NDAs in place, we'll then start to release that additional sales documentation that we've just gone through the preparation stage of. We're then looking, once we've got sort of engaged parties, to get offers, generally in a sort of multi-stage process. So indicative offers, usually followed by some sort of follow-up information, quite often site visits in that period of time as well, until we get down to essentially a hopefully a selection of finalized offers that our sellers can basically make a call on which one they'd like to pursue, and we do so essentially through a set of heads of terms, so relatively short legal document that allows us to progress forward with an understanding of the transaction under a period of exclusivity with a buyer. We're then into essentially sort of 3 sort of bits of work really left. 1, due diligence. Calling that one is probably misleading, because actually there's multiple streams of diligence, whether that's financial, legal, tax, commercial, property, all sorts. And alongside that, you've got essentially all drawing up all your legal documentation, and ultimately looking to get towards touch wood, a successful completion. So a lot of stages there, and I guess giving some context to what that looks like in terms of time frame. I mean, if a business is kind of ready to go and we're not spending a lot of time in that pre-preparation phase, then we're probably looking at not less than 6 to 9 months generally. So yeah, like I say, it could be significantly longer if we're spending longer in that planning phase. I don't know, Matt Pierce, do you just want to make a comment around? I mentioned the due diligence phase, about how long that sort of typically taking, and whether that's changing current market.
Yeah, I think it's probably a 6 to 8 week process in general. That sort of assumes that you've got good quality information ready to go and you're getting good engagement from the seller. That has lengthened. I think previously we were probably seeing that closer to the 4 to 6 week mark, but there is just that extra level of scrutiny that's going on at the moment. I think the key point there, and we'll cover it in a bit more detail later, is the preparedness. And as you said, there's multiple diligence streams that are all having demands on the seller's time and on management's time. So the more prepared you can be, the more streamlined that process will be.
Completely agree.
Thanks, Matt. We've had our first question in. So it says, would you ever go to a contact directly, or does it always go out to the market? So we will always go direct to the buyers that we think can make the transaction and can afford the transaction. Now that varies depending on the sector and the business in question. The extent of how many buyers are in a position financially and strategically to pay the price that the sellers are willing to accept. Now the key is, in certain organizations, finding the right contact and finding the right person to have the discussions that has the authority to take the transaction forward. Recently we've been dealing with some large US buyers, for example, whereby these are mammoth organizations, and actually finding the right person is hugely important. So that goes back to the research that we do and how we can actually find the right person directly. It's not on an open market. It's not put on a put openly for anyone to have a look at. It's a discreet approach, and only the individuals or the companies that a seller wants you to go to, we will go to. It's an authorized list. Fine. And then I just, in terms of the process, Chris, can you sort of cover perhaps the benefit of a competitive process on maximising value in terms of how how that would work?
Yeah, no problem. And I think that kind of comes back to this question as well around going out to market and whether we're going to 1, 2, 3, 4, 5 buyers. The word competitive, I think, is key in there. So it's always the balance between how many people you go to, but the advantage of having several buyers with an ability to transact is that if they know they're in a competitive process, we're in a lot stronger position from a negotiation position.
Mm-hmm.
So ultimately, we will try and run a competitive process wherever we can, and that is one of our levers to pull to maximising value. The minute that a buyer thinks he's the only one in a transaction, you lose some of that negotiating power, and that's not just in terms of initial bids, size of offer, but this, we just said this is a 6 to 9 month process potentially, and there are negotiations throughout that, whether it's negotiations of heads of terms, negotiations of the SPA, the main legal document. Having some awareness that there is a competitive process and there are other people that we can go back to is one of the key, our key levers there. So generally, we will always try to look at run a competitive process if we can.
Yeah, and we'll cover vendor due diligence a little bit later, which is another tool that we can use to sort of keep control of a process. And I think control is the key word when it comes to these sorts of things, and trying to maximise value, and rather than passing control to a buyer, which then inevitably leads to less value. So just focusing on this planning phase really to start off with, I suppose, when should shareholders start to think about these things, and what are some of the common issues that we will perhaps look to address during that planning phase, which can take a bit of time?
Yeah, do you want me to take that one, Matt?
Yeah, if you want to kick up.
I guess a client could come to us and say we want to sell tomorrow, and we could look to start that process. But I think what you need to consider is actually, is that in the best interest of the sellers? And ultimately, in terms of maximizing value, it might not be the right time to go to market. And there are several factors that might play into that. Is it the right time for the business? Is it the right time for the wider market? Look at things within your business that could impact that, for example, and potentially issues that can't be solved overnight. So what do we often see? Owner managed businesses, for example, is there a high reliance on the exiting shareholder or shareholders? If their name is above the door and they walk out, what's left is a common issue. And kind of linked to that, therefore, is there an appropriate management team or second tier management team in place? And if there's not, realistically, how long does that take to put in? A lot of the buyers that we deal with don't have their own staff members and directors that they can parachute into acquired businesses to run them. So there is some reliance on an existing management team and some continuity there. And I think Nicola can cover some of the ways that we can look to incentivize the management team a bit later. Again, probably one for Nicola, but is there restructurings that need to happen before a sale, for tax purposes? What's the trading outlook of the business? Especially coming off the back of COVID. I mean, some businesses were up and down and all over the place, and actually, sellers may know that the outlook looks rosy, but have you started to see some of that coming through? Or actually, would waiting 6 months really improve your chances of not only getting a better offer, but getting a successful transaction away? And I think probably the takeaway from that is there's not a set answer, but it's never too early. So if it's on the cards, it's something that you should sort of consider sooner rather than later.
Yeah, thanks, Chris. I think that management piece is quite interesting, because of course it goes back to what are the shareholder management's objectives? Because it's not uncommon for us to see shareholders who are looking to sell, but actually are quite comfortable staying in the business and being that either transition or actually de-risking in part and actually trying to benefit from future upside through an earn-out or a retained ownership. So again, it goes back to those objectives. What is the objectives of the shareholders if they are management and if they're one and the same? Okay, thanks for that. So let's just move on to a bit of tax. So maximizing value is normally the number one objective for everyone. But as you mentioned, Nicola, at the outset, what shareholders actually receive in their pockets after tax is going to be critical. And clearly, with rates as they are, with potential changes to tax rates going forward, who knows? There's potentially quite a bit to think about, isn't there?
Yeah, there is certainly, and there are quite a few things from a tax point of view that would benefit from looking at an early stage. Chris mentioned a bit earlier about potentially wanting to restructure as well before a sale, and there are certain ways that you can do that and achieve it without tax charges, which if you do it at an early stage before a sale can be advantageous. So, for example, is there more than one trade in the business? Would they be more valuable if you separated them out and sold them separately? Or you might want to keep one. Or, for example, there might be properties within a company which you might want to keep and lease back to the company, keep as a property rental business with the income. If you can separate them out sometimes at an early stage, again without achieving that tax neutrally. With properties, we do see that quite a lot, and sometimes it's not certain whether the buyer might want to keep the properties or not, and you can extract the properties as part of a sale process usually, but usually the tax burden on that will be higher than if you do it at an earlier stage, so demerge the properties out at an earlier stage. So there's a bit to weigh up there in terms of how certain are we that we want to keep those properties and that a buyer won't want them. There's also other types of tax planning to think about, maybe from a personal point of view. So, for example, do you want to think about what happens with these cash proceeds that you might receive? Do you want to set up any family trusts, for example? And it can be advantageous to do that at an earlier stage rather than waiting until after a sale. Another point to think about is checking the share capital structure of the company, particularly if you've got more than one class of share and a number of shareholders. So, for example, do those shareholders you're expecting to qualify for business asset disposal relief, which can reduce the gain to tax to 10% on the gain? Do they qualify? The test is broadly that you need 5% of the shares, but there are some nuances there to check. And also, do your company's articles properly reflect classes of shares? And so, in terms of the capital rights to the sale proceeds, are they correctly reflected in the articles? If they're not, that can lead to problems on the sale. So potential PAYE charges, which can mean you've got tax rates for 50% plus rather than your 20% or 10% CGT rates. If these things can be spotted at an early stage and dealt with, then it's usually there are usually things that can be done to help mitigate the position and mitigate the tax.
Thanks, Nicola. I think it's fair to say that probably the majority of issues that we are involved in resolving earlier in a process or pre-process are either tax or share related. And I think the issue is that later in the process, if they are spotted, you're heading towards completion, sometimes they do come up, and that these are the sorts of things that can be deal breakers. These are the sorts of things where a buyer can, you can lose a transaction. So they're hugely important because they can have a huge impact on what the shareholders actually receive or whether the deal can go ahead in the first place.
Yeah, definitely.
Okay, there's a couple of questions that I'll I'll pick up on. So first one was, are there any particular industry sectors that we operate in? Chris, do you want to tackle that one?
Yeah, I think it's fair to say that we're largely sector agnostic. We will work with businesses in all sectors. I mean, the reality is within the team, typically there are individuals who have got sector specialisms. So, for example, I've done a lot in the financial services sector, in the insurance sector, as well as in the holiday letting sector and in manufacturing. But across the team, we've got, you know, pretty much specialisms in typically all the sectors that we come across, you know, especially in the region. So the short answer to that is we'll cover everything, but there are typically sector specialisms within the team.
Thanks, Chris. And there's also a question around, do we work for clients or prospective clients that aren't clients of the wider firm? Yes, we do. Is there a lower size? No, not really. You know, if we can help on a transaction and it makes sense for both parties, we will. Okay, so let's move on to a bit more of the sort of, I guess, management incentivization piece. So, you know, when you've got a situation where perhaps there are members of the management team that aren't shareholders, you know, undertaking a sales process is a hugely important step and stage for the shareholders and the business. And in order to maximize that value, quite often getting a management team who are moving in the same direction, who are incentivized to try and undertake the things that would help maximize the value and increase the chances of success, you know, can be quite important. So just in terms of, you know, management incentivization, Nicola, you know, what are the sorts of things that owners can look at to try and make sure that they get the best result for them and the team?
Yeah, thanks, Matt. So it's definitely worth considering whether you can put in place a tax efficient type of incentive scheme. So if you get to your sale process and you say, oh, I want to give my management team some money, then really, or part of the share of the proceeds, you're really looking at that being taxed as effectively a bonus, so taxed at PAYE and NIC rates. But if you can possibly put something in place prior to any sale process, such as, for example, enterprise management incentive options, then you can incentivize the team to grow the business towards a sale, and also give them part of the proceeds of the equity as well, which can be then taxed at capital gains tax rates, often at 10% with enterprise management incentives if they're held for 2 years before the sale. So it is really worth considering whether you want to put something in place at an early stage, which could be tax efficient for the team and really incentivize them to help grow the business.
Yeah, I think you know, quite often we're in transactions where, you know, there may not be a formal share incentive plan, but, you know, the owners want to recognise the efforts of management team, and looking at completion bonuses and things like that is not uncommon, but obviously not as efficient in terms of tax.
No, that's right. So yeah, completion bonuses, or even sometimes unapproved options, which could be put in place at the later stage, which are still taxed as PAYE, but sometimes can do better for corporation tax purposes. You can still do that at a later stage, but if there's something you can do more efficiently a bit earlier, then that's definitely good to think about.
Thanks, Nicola. Okay, so I think let's move on to sort of maximizing value, and you know, I suppose any valuation is going to be heavily financially driven. So let's look at what are the sorts of things that are going to play a big part in that you know, that valuation from a buyer, and what are the sort of things that sellers can do to perhaps present their business financially, at least, to try and, you know, lead towards that high valuation. Matt?
Sure. Yeah. So I suppose on a high level, most buyers will look to value a business based on some multiple of earnings. So that sort of gives you two major levers in terms of maximizing value, one being the multiple and one being the earnings. So without going into too much detail on the multiplier, because there's a sort of previous deep dive session we've done on valuations, but you're sort of trying to persuade a buyer to pay a premium for what you're selling. And part of that comes on down to sort of the story you're telling, sort of the value of a brand, the growth opportunities, the market position, and Chris will cover sort of buyer story in a little bit. But the other lever is then earnings. So what we'll look to do is try and present sort of the rosiest view of earnings as possible. So that might involve taking your historical earnings and adding back exceptional costs. So things like legal or professional fees that you might have incurred outside of the ordinary course of business, bits like that, you'll look to add back to give the sort of core underlying earnings of your business. Some of the other bits we might look at might be the sort of current run rate, especially in a growing business. There might be things like new significant contracts or customers that have been won, things like new business streams that might not be fully captured in historical information that you want to present to a potential buyer to improve their view of your earnings. We'll look to come up with some sort of run rate calculation to show the true current position of the business, and also if it's a business that's showing strong growth potential, I think looking at forecasts and projections is important. So could you persuade a buyer that they should be bidding and valuing your business based on their future earnings as opposed to what they've currently achieved? But clearly, from my point of view, as someone who normally works on the buy side, all of these things have got to stand up to a bit of scrutiny. And one of the first things we'll do as a diligence provider is come and start picking apart some of these earnings bits. So there's got to be strong logic, strong reasoning, and support behind all of these adjustments, and your run rate and your forecast have got to have a good solid basis in quality financial information and quality assumptions. I think also, different buyers will be looking at things in a slightly different way. So just positioning that correctly for the type of buyer you think you're going to be approaching is important. So we mentioned a synergistic trade buyer previously. I think, if that's the route you go down, presenting certain costs that might be obvious for synergistic gains, whether that's sort of back office costs that may be able to be stripped out by a potential buyer. I think presenting those costs obviously helps the buyer form a view of what they might be able to achieve going forwards.
Thanks, Matt. So I think it's fair to say in presenting the financials, there are no rules. It's not like a set of accounts. You can present it in the most imaginative way possible, but that needs to stand up to scrutiny, is what we're saying. Because ultimately, any buyer is buying the future of this business. They're not buying the past. And how can we present that any business in a way that demonstrates what that financial future might look like is obviously hugely important. I think one of the sort of war stories we always hear about is that someone's been approached and they've just sent historic accounts unadjusted and with no commentary, and it really can, you can be shooting yourself in your foot if you've done that and you haven't actually been on the front foot to present the financials in that way. So, okay, beyond the financials, that's the sort of quantitative side of things. What about the sort of qualitative? In terms of what is the story and how do you present a business to a buyer so that they really want to pay that multiple? They really want to take this to their board and say, these are the reasons they want to do it. Financials aside, this is strategically why it works for us.
Yeah, I'll pick up on that, Matt. So I've already mentioned that when we go to market with an information memorandum. So that's setting out information about the business, whether that's history, background, clearly financials, products, services, staff, premises, etc., etc. but key is how we present that. So we refer to this as the buyer story. So like Matt said, what's the buyer going to look at and go, this is a great opportunity, I can take this to my board, I can justify it as an acquisition, and I can justify spending a lot of money on it. And depending on the type of buyer that we're envisaging going to, then actually those value drivers and those sort of key USPs that'll make them pay more will be different, as Matt's already said. So the sort of things that we look to build in, I mean, key in any information memorandum is the opportunity section. So that's kind of twofold. So what opportunities are on the table at the moment and being pursued, and actually, what opportunities haven't yet been pursued. I mean, we talk to business owners all the time and say, well, we don't want to do that. That we haven't looked at progressing that opportunity, but actually it's almost remove yourself from that situation, put yourself in the shoes of the buyers, look at the resources they've got. Actually, is this something that they could pursue? So actually setting out those opportunities for growth is key. Now, clearly, the more that you can demonstrate that those opportunities are possible, or even better, that we've made some headway into achieving and securing, I don't know, new product orders for new product launches, for example, the more that we can do that, the more that we can sort of back that up. But yeah, I guess other things that sort of might come into that, which we've seen historically, Matt Pierce mentioned growing businesses. We've taken businesses to sale where they've got multiple branches, for example, but actually when you dig into it, some of those branches are in their infancy and they're not yet profitable. We also know we've got a pipeline of new branches that we're looking to open in the next couple of years, and actually buyers buying that future, so they want to understand what it looks like under their ownership. Matt Pierce mentioned synergistic sort of cost opportunities that some buyers might look at and go, we've identified these costs, we think we can save them, and okay, there's an argument there. To what extent do they give you the value for that, if they're thinking that that's value that they're bringing, which is a fair argument. But also, are there going to be opportunities within the buyers group for cross-selling, for example? So lots to consider, and I think what's important to recognize is this is not just informing what narrative we put in any information memorandum, but it's also potentially informing your commercial and business strategy in the lead up to a transaction. So, if you are thinking about going to market and there's a new product launch coming in 6 months, or a rebranding or something like that, actually, is it worth holding off until you can show some traction in that? Because when you do, better chance of securing value for it. So yeah, it's not just thinking how we present something, but also influencing potentially how we act in the lead up to a sale. Hopefully, Matt, that's covered enough for now.
Yeah, I mean, I think that it's all about looking at it from a buyer's perspective and seeing what is it in this business that they will value. And quite often, before approaching a market, we might look at the potential buyer pool, perhaps look at the transactions they've done, the things they've done in the market, have perhaps initial anonymous conversation to understand what it is that they're actually going to be looking for in their acquisitions. Because it's that, it is that future rather than the past, and that qualitative analysis to allow them to pay a higher multiple against the adjusted profit is that the combination of the two is how you get to that the higher valuations. Okay, so let's look at buyers. So that clearly is a critical part of the process here. How do we find the right buyer for the right business? Because if we've done all this presentation and preparation, but actually we don't have the right, we're not speaking to the right people, it's all a waste of time. So how do we go about that?
Yeah, well, I think the first stage is actually thinking about what sort of buyer we're after, and that comes back to the objective, understanding objectives. We spoke about that right at the start. So, if is this a private equity style transaction? Is it high growth? Are we after private equity type buyers? In which case that's going to dictate where we're looking. But actually, is it purely people who are going to be in the trade? In which case we might look at doing sort of sector mapping, and saying, okay, who in this industry has done previous transactions, or in this industry sector have done previous transactions? What parties do we think might be interested both up and down the supply chain? And ultimately, if you think about who generally knows people in their industry the best, quite often it's our client. So we will bring expertise in knowing, for example, those equity players, the debt players. We will work on a lot of transactions. We know who has appetite to do more, but we won't know every industry inside and out like some of our clients do. And it's quite typical that people have had approaches in the past. They've had discussions at trade shows that say, if you ever think of selling, we'd like to be on that list. Now, quite often that list is quite long, and that doesn't necessarily mean to say that these are viable options. I mean, we do quite a lot of buyer vetting when it comes down to actually looking at their ability to transact. So that list can start off quite long and end up quite short, and actually how many we end up with kind of depends on our go-to-market strategy. Generally a toss-up between sort of level of control and competitiveness, and also sort of confidentiality as well. It's not unusual to have buyers on a list of potential buyers that look fantastic on paper, but shareholders go, we wouldn't sell to them in a million years, and actually we don't even want to risk an initial conversation. So it's always a balancing act. We also engage with buy side search agencies as well. So these are typically agencies that are employed by serial acquirers, that are on the lookout for potential targets and ultimately get paid by the acquirer. So we work with them. I think overall it's just worth saying it's a collaborative approach with our client. And the other thing that's quite nice to think about during that time as well is, if we're anticipating and approaching the market, what's the company selling company's image like in that market? So is it a good time to start making additional noise in the market around market publications around successful trading, successful product launches, that sort of thing? So lots to consider, but lots of ways of tracking down potentially appropriate buyers, Matt.
Okay, there's a question that's just come in that's relevant to that. So how do we get the information to work out that a potential buyer has the ability to do so without informing them? Do you want to tackle that? Or Matt?
Yeah.
Yes?
Okay, yeah, Matt can take that.
Yeah, so I think Chris covered a couple of points there. So I think understanding transactions that they've previously undertaken in the market will be quite key for that. Which there's publicly available information for that. Also a review of any other publicly available information from Companies House, etc. I think also going in on that the no names basis initially, and having those initial discussions with potential buyers also gives a bit of insight into their ability to be able to undertake that transaction. I don't know, Chris or Matt, if you've got any other
I think that what I'd add to that is looking at the ownership of that business, because you may look at a business in a particular sector and they may themselves not have the financial means, but if they are linked as part of a larger group, or potentially if they're private equity backed. And I think a characteristic of the market, the last 12, 24 months is that private equity is playing a much greater part, either directly or indirectly. So we're seeing a lot more private equity backed businesses making those acquisitions. And if you purely looked at the financials, you wouldn't go, they are an obvious buyer, but knowing that they're backed by private equity gives you the confidence that they've got the means to access that capital if they need to. That's yeah. Okay, so let's talk about housekeeping and perhaps preparing for that due diligence process. So, what can go wrong? What do we see going wrong? What can shareholders and businesses do to prepare for that process of due diligence? I think that's probably squarely in Matt's court.
I think so. Yeah, so I suppose just a brief overview of what we tend to look at as part of financial due diligence and what our scope tends to be. So typically we'll look at 3 years of historical information. That's probably monthly management accounts on the profit and loss side and hopefully cash flow side, and then a real focus on the year-end balance sheets. So almost similar to audit processes on the balance sheet side, but a much more commercial view on the profit and loss side compared to what you typically see as part of a financial audit. And I suppose the key focus areas from a buyer's side are first to really get under the skin of those underlying earnings. So we talked about maximizing value through presenting that the best picture of historical, current and future earnings as possible. The buyer will want to make sure that figure that they've bid on, it stands up to scrutiny. So that'll involve that analysis of monthly management accounts, looking at key trends, really trying to understand the key drivers of that. And really the gold standard that we love to see on the buy side is all of that being supported by good quality operational information. So not just monthly revenue, but what's driving that? Is that revenue by SKU, sales volumes, even volumes by salesperson? So you can really get to understand what is it that's driving this business month to month, and to then give comfort that that's going to be able to continue going forwards. If the bid has been based on forward looking, we'll look to try and review a good set of forecasts. So I think especially in a growing business, not just presenting management budgets but looking to invest into a proper forecast model is really valuable for diligence, because it allows us to see how those historical trends, historical drivers, operational information feeds into those forecasts and creates that sort of data-driven view of how this business is going to continue to deliver the earnings going forwards. And ultimately, we're just looking to give the buyer as much confidence as possible in the performance of the business. And where that's not possible, where the information is not available or management responses don't stand up to scrutiny, that's where you start to see buyers reevaluating their offers and price chips coming in. And I think one of the key areas there, especially on the earnings side, is current trading, especially when you're going through a process. Your attention's been pulled in lots of different ways. Where current trading drops away, that can be quite a big red flag. So it's not just preparation of that historical information and bits like that. It's continuing to make sure the current trading stands up. One of the other areas we look at as part of diligence is sort of the key risk areas in the business. So this could be something like a high concentration of customers, but then what we'll be looking for in diligence is then how can that risk be mitigated. So one of the best things a buyer can do is look through their business, maybe come up with a risk register, or look through at what the seller believes the commercial risk could be, but then to come up with what are the mitigating factors and how can we demonstrate that these risks can be mitigated. And then one of the other key areas is looking at the composition of the balance sheet, and this is an area that post the initial offer can have quite a big impact on the final value that's paid. So understanding the composition of your balance sheet prior to going into a diligence stage is quite important in terms of how we can then position the balance sheet to make sure we maximize value. So in terms of other areas, other things you can do to help prepare, as part of the due diligence team, we're increasingly working on the sales side. So we'd call this a vendor assist type engagement, but we sort of sit with the sellers and look through their historical information almost as though we were on the buy side, but preparing it to stand up to due diligence. And as part of that, we can then start asking the questions that a buy side diligence provider would be asking, make sure that the mitigations, the responses are all in place to help safeguard value. And we could even take that one step further. Matt, you mentioned vendor due diligence earlier. This is where instead of the buyer paying for due diligence, it's paid for by the seller. And the sort of benefits of that are maintaining control of the messaging, I think, as much as anything. So, when I undertake a vendor due diligence engagement, there's no real change in the overall approach, but it allows the seller the opportunity to make sure these issues are positioned in a slightly more seller-friendly way, and lets the seller present the mitigations against various risks, so that the buyer, although they understand the risks, they also understand why it shouldn't be a value-affecting issue.
Yeah, I think that vendor due diligence is quite an interesting one. It's, I think when we are expecting a very competitive process, when we've got a premium asset business that we think there's going to be a lot of bids, it also allows us to maintain control of the process, because we can get typically you get an offer that's pre-due diligence. You then go through a due diligence process where there is clearly risk and uncertainty. If we can get offers following due diligence and still have multiple parties looking at it, you're much more likely to have a shorter back end and more control over it, inevitably leading to a greater valuation. But it's there's that the toss up is a bit of cost for vendors, and it's appropriate in some circumstances and not others. I think it's fair to say.
Yeah.
I'm conscious of time, but Nicola, anything else from tax side on sort of that due diligence process?
I think just a couple of points to say that the buyer will carry out the tax due diligence exercise as well, normally, perhaps alongside the financial due diligence, to check what tax risks might be within the company. So you can prepare for that by carrying out a bit of either vendor due diligence or some vendor assist work, just to look at what some of the issues might be, particularly which gives you the opportunity to correct anything. So we talked earlier about the shares, can anything be done there actually to correct the position or present it in a light which the buyer will be more accepting of the risk. So that can be a valuable exercise. But also as well, identifying any tax assets that could be valuable. So a typical one might be if you do have options, so option incentive scheme, then usually there'll be a corporation tax deduction when they are exercised pre-sale, which can be valuable, and as sellers you will want to try and get some of the benefit of that. You can identify that early and even include it in the information memorandum perhaps, and you've got more chance of being able to get value for that on the sale. And another point as well is that there'll be also some legal due diligence happening as well alongside all this other due diligence, and sometimes it's beneficial from a tax point of view to work with lawyers on certain aspects, particularly in relation to the share capital issues that we talked about earlier.
Yeah, absolutely. I think the value of a good corporate law team as part of the process is hugely important, and working with various ones, it does make a difference to the outcomes and risk for the shareholders. So that's probably just worth mentioning there. Okay, thank you, Nicola. So I think we've got not too much long, but perhaps very briefly, can we cover the communication with the team? So if individuals and staff become aware of a process, clearly that uncertainty can have problems. But one of the questions we're always asked is, when do we tell the team? How do we tell them? What do we do? And how do we consider that? Chris, what's your views on that, and what you tend to see?
Yeah, carefully, I think, is the overall messaging there. So generally, I think overall theme is that we try and restrict the people who know about a potential transaction as far as possible. There's a confidentiality point there, but also, like you mentioned, Matt, confidence. The concept of a transaction, a change of ownership, can be upsettling. I mean, change is always unsettling for a lot of people. So we just need to bear that in mind. So whilst we like to keep that sort of circle of trust as small as possible, we also need to consider, though, actually, are there people that need to know because actually they need to be involved to help the deal across the line? So a classic example outside the main shareholder group is if you've got a financial controller or financial director who is all over the numbers and the shareholders might not be, then actually there might not be any other option but to get him or her involved in that process. Again, the messaging there is key. That might be an example where actually that individual is incentivized through the process in some sort of way. I think if you're considering the sort of wider staff base, then the answer is generally they aren't informed until the transaction has happened. I mean, ultimately, until the SPA is signed, the deal is not done. So you have to bear that in mind. It's typically something that happens post-transaction, and usually something that the buyer is quite heavily involved with, because for them, as well as the exiting shareholders, the messaging to staff is crucial. Ultimately, they are reliant on them post-transaction, so they need to manage the process, carefully.
Yeah, I think we've on recent transactions we've seen that where the outgoing shareholders can paint a picture, but actually it's the incoming owners that are going to be the ones that dictate what is going to happen. So having that sort of joint communication post-transaction, I think is hugely reassuring to staff, and is important to get right. Okay, right, we've only got a few minutes left, so there's a couple of questions that we've got to cover. So the first one is, how and when do professional advisors charge for their services? So from our perspective, it does vary. So we sometimes act on a time cost based on the amount of time we spend on a transaction, or we can undertake some transactions on a contingent or semi-contingent basis where the outcome of the transaction is dependent on how we're remunerated, and we're incentivized in many cases based on value, perhaps, as to how we get paid. So we're aligned with the shareholders. We've got one here saying our business has professional indemnity insurance in place. Would the director of the business need to maintain this insurance, pay for coverage post sale? I'm probably looking at that in the basis that the buyer the company needs that insurance in place if it's on behalf of the company, so that the directors probably wouldn't personally need to do that unless there's some other form or other area of professional indemnity that they're talking about. That's a buyer cost, I would say. So I think that's all our questions, and I think we're just running out of time. So I think just in terms of a very brief wrap up, clearly preparing for a business is not a 5-minute process. I think we're going back to the initial remarks. What we're seeing is a direct correlation between those that are prepared and those that have good outcomes. From our perspective, early preparation is key. It's never too early to start this, and the more that you can do before you enter a process inevitably leads to, I guess, a maximising its value, but also mitigating some of these issues that could quite easily be deal breakers that you could do something about beforehand. And I think, closing remark is there's plenty of support out there. We're happy to have these initial conversations and see where the things that we identify as preparation points are. And also don't forget the tax. That's a key point as well. That's closing remark. But finally, thank you for everyone for joining. Please feel free to reach out to any of us if you've got any follow-up questions, and enjoy the rest of your day.